Hello and welcome to this section on variable annuities. An annuity is a contract between an individual and an insurance company, and once that contract is entered into, the individual becomes known as the annuitant. There are several different types of annuities, and we're going to start our review off with defining the characteristics of each type of annuity. A fixed annuity is a contract between an insurance company and an individual that offers that individual a guaranteed rate of return. A variable annuity contract, which offers the individual a payment that can vary along with the performance of the securities inside the insurance wrapper. A variable annuity is considered to be both an insurance product and a security. So an individual who sells variable annuities must have passed the SIE, the Series 6, or the Series 7, and must also have a state insurance license. Now, the person who sells a fixed annuity is only required to have an insurance license and is not required to have a securities license. Therefore, the questions on your test will indeed focus on those variable contracts. Because a fixed annuity may offer a rate that is not encouraging or high enough for certain investors, and the variable annuity may have too much risk for other investors, well, of course, there's a combination annuity that has a fixed component where the individual is provided with a guaranteed rate of return, and a variable portion which hopefully provides the individual with an increased rate of return. Now, let's take a look at the fixed annuity contract a little bit more closely. With a fixed annuity contract, the individual has no investment risk. The entire risk is taken on by the insurance company. If the insurance company guarantees you a stated rate of perhaps 3% per year, if the insurance company cannot provide that rate based on their investments, they must go into their own pocket to provide it to the investors as promised. All of the investment risk is absorbed by the insurance company. Money invested in a fixed annuity contract goes into the insurance company's general account and is used to purchase conservative things like mortgages and real estate and perhaps even some government bonds. The mortality risk associated with an annuity contract is that the individual is going to live much longer than the insurance company predicted. The mortality risk, therefore, is absorbed by the insurance company, and they deduct a fee from the general account to help pay for that risk. The operating risk is the risk that the cost of being in business goes up, rents go up, phone bills go up, salaries go up. This is a business risk. That is also absorbed by the annuity company or the insurance company. And then once again, they deduct a fee to cover these risks from the general account. What is absorbed by the individual in a fixed annuity contract is the purchasing power risk. The risk that inflation comes into play and the guaranteed rate is not high enough to offset inflation. If the guaranteed rate was perhaps 3% and inflation started to really heat up and was running at 4%, well, this individual would end up worse off each year because of the loss of value of the dollar through inflation. So purchasing power risk is absorbed by the annuitant with a fixed annuity contract. The individual who wishes to try to outpace inflation would be more appropriate for a variable annuity contract. With the variable annuity contract, money is invested in the insurance company's separate account. The separate account is used to hold the investment monies where contract holders contribute their premiums. It's much like a mutual fund. The separate account is considered to be an open-end investment company or a mutual fund inside the insurance wrapper. And that is the case when the insurance company invests directly in the stock market. meaning they have an investment advisor there determining what stocks to buy or sell, and the performance of that separate account therefore helps drive the value of the individual's annuity contract. If the insurance company invests indirectly into the stock market, meaning the separate account takes the money and purchases mutual fund shares, the separate account is registered as a unit investment trust under the Investment Company Act of 1940. Either way, the separate account is seen as an investment company or a security inside the insurance wrapper. Once again, there are a couple of risks taken on by the insurance company. The mortality risk, again, is the risk that the person lives much further down in life than the insurance company had anticipated. We've all heard stories about people who are 102 years old, running marathons and going to work and having great lives still at, this advanced age. And that is a concern for the annuity company, who has promised to pay these people for as long as they live. So that is the mortality risk, and they deduct a fee from the separate account. Once again, there's an operating risk, and the risk is that the cost of being in business goes up, and once again they deduct a fee, and once again here on the variable contract, it is from the separate account. What the individual with a variable annuity absorbs is the risk of the loss of value. So all of the investment risk is placed upon the individual in the variable annuity. The variable annuity, many of them don't offer a guarantee. Some do, and we'll talk about that later. But the loss of value or the investment risk is absorbed or borne by the annuitant in a variable annuity contract. Now, we need to take a look at some popular annuities, and those are known as equity indexed annuities. An equity indexed annuity is a contract that provides a return that is tied to a stock index, such as the S&P 500. So the return of the account, or the return of the annuity contract, is designed to provide a return that mirrors or resembles the return of the S&P 500. Now, there are a couple of features here with the equity indexed annuity, and one of them is that they will very often provide the investor with a minimum guaranteed rate. The minimum guaranteed rate is the worst that this investor could do if the stock market happens to crash. There will also be a maximum rate. The maximum rate is the most the investor or annuitant could hope to receive if the market did exceedingly well. So the minimum comes into play when the market does poorly, and the maximum comes into play when the market does exceptionally well. Now, with these type of contracts, the investor will not get 100% of the return of the actual index. Most of these contracts will tell you what the participation rate is. This means that this is the rate of return, or the percentage of the return of the index that you will receive. And in our example here, we have a participation rate of 70%. We've set a minimum guaranteed rate of 2%, and we have a maximum rate of 12%. And here on the slide, we have a couple of examples of the return of the S&P 500. If the S&P 500 returned 10%, with a 70% participation rate, the investor would expect the value of their account to increase by 7%. 70% of 10% is 7%. That's how we determine what the investor would receive, or how much the investor's separate account or portfolio or contract would appreciate. Now, if the market had a bad year, had a down year, and the S&P 500 was down 5%, well, the investor would expect to receive that minimum guaranteed rate of 2%. And in our final example here, we have the S&P 500 appreciating very significantly, 20% in 1 year. And when we take a look at the return of the S&P 500 at 20%, and we multiply it by our participation rate of 7%, we realize that that is 14%. And that amount exceeds our maximum rate. So therefore, in this scenario, we are credited the maximum rate of the contract, which is 12%. Here we gave up a little of that upside appreciation. And the reason people do this is because they are given downside protection. Now, sometimes variable annuities will not give you a participation rate, but will instead state it as a spread rate. The spread rate is the rate the investor does not receive. So in our first example, we had a participation rate. That is what the investor did get. But if they gave you a spread rate of 3%, as we have here on the presentation next to me, and the S&P 500 returned 10%, well, the investor would give up 3%, and their account would appreciate by 7% that year. Kind of just two different ways to come to the same conclusion. So equity index annuities, testable for most people. I would have a good command on the different terms and conditions. And remember, the only time that the minimum comes into play is when the market does poorly, and the only time the maximum comes into play is when the market does very, very well. Now, investors who purchase variable annuities for the exam are exclusively doing so for income now or income later. The only reason a registered rep on any of these exams recommends a variable annuity contract is for someone who is seeking income now or income later. It is not for tax-deferred growth. It is not for a big purchase like saving for a second home. It is not to pay for the kids' college education or anything of that nature. I think we've called it out really clearly in red on the presentation. Now, there's certain sales practices you need to be aware of regarding variable annuities that are red flags for regulators. Money into a variable annuity contract goes in after tax dollars, and it is allowed to grow tax deferred. If an investor wants to move money from one variable annuity contract to another variable annuity contract offered by another insurance company, they could undertake a 1035 exchange, which would allow them to do this tax-free. However, this is a red flag for an abusive sales practice. Variable annuities are long-term investments and have surrender periods, meaning you can't access your money for several years. If you need to access your money during the surrender period, you're going to pay a significant sales charge. So if an investor were to listen to a representative who wanted them to go from one variable annuity contract to another after their expiration of their surrender period, well, now they would be subject to a new surrender period and they would pay new sales charges. So red flag for abusive sales practices with those 1035 exchanges. Now, sales of L-share annuities. An L-share annuity is one that has shorter surrender periods but higher fees and expenses. Sales or recommendations of L-share annuities can also be abusive sales practices. Again, remember that the annuity is only to provide income now or later, and it is to supplement or augment a person's other retirement assets in most cases. So how can people buy annuities? Variety of different annuity purchase options. You could have a single payment deferred annuity. With the single payment deferred annuity, an investor funds the contract completely and leaves the money there to grow to provide a revenue stream sometime in the future, probably after retirement. Let's see if I can give you a little bit of an example here. Let's say someone is a mid-level manager at a big tech company and they bring in a project much sooner than anticipated and significantly under budget, and as a result, their company gives them a $100,000 bonus. Now, this person may want to go down to the local car dealership and buy themselves a new sports car, but they think better of it and say, I should put this away for retirement so that I can have some income when I retire. So this investor may very well take that $100,000 and fund that contract completely. The purchase of the contract will go towards accumulation units, and they will be there growing, waiting for the investor to annuitize the contract. With a single payment immediate annuity, the single payment immediate annuity, the investor funds the contract completely with one payment and begins receiving checks immediately within 60 days. The purchase of a single payment immediate annuity goes towards annuity units, and those payments are immediately being paid to the investor once the contract has been established. Let me see if I can give you a little bit of an example of how this might take place. Well, we live in the Northeast, and many of you may be in different areas of the country, the world, but in the Northeast, real estate prices tend to be pretty high, and when people retire, they tend to go down south where the real estate prices are a little bit more affordable. So perhaps someone sells the big house in the northeast section of the country and moved down to, say, South Carolina, and after they've sold their home in the Northeast and purchased a home in South Carolina, they have $300,000 left over. And they take that $300,000 and they put it towards an immediate annuity to provide them with monthly income to enjoy during their retirement. So that's kind of an example of when someone would purchase a single payment immediate annuity. Now, many people don't have lump sums to fund the contract, so how would people who don't have lump sums to fund the contract purchase a variable annuity? Well, they would purchase the variable annuity with a periodic payment deferred annuity. Perhaps they're putting in $500 a month, and every month they contribute to their account. The periodic payment deferred annuity, the money goes towards the purchase of accumulation units, and hopefully over the period of many years, this type of investor can build up a significant value and use that to create cash flow or income in their retirement years. All right, let's take a look at accumulation units and annuity units a little bit more closely, and let's try to understand the different operational aspects of each of these types of units. When an investor is putting money into a variable annuity on a periodic basis, or they are funding a contract completely with a single payment and leaving it there to grow, these investors are buying deferred annuities. When you have a deferred annuity contract, the money that has been contributed to the contract goes towards the purchase of accumulation units. The number and value vary. As the value of the separate account goes up and down, the value of the unit goes up and down. And when the annuity unit spins out or pays off distributions, those distributions are reinvested into the separate account and used to buy more accumulation units. So when you have a deferred annuity contract, the investor buys accumulation units. When an investor has a single payment immediate annuity, they purchase annuity units. The number is fixed. It does not change, and the value varies. It goes up and down. The number is fixed because now we're withdrawing money from the contract. We're taking those distributions and we're receiving them in a check. Therefore, the number remains fixed and the value goes up and down. When someone goes from the pay-in phase to the payout phase, they are said to have annuitized the contract. They trade in or surrender their accumulation units for annuity units. And at this time, the investor selects a payout option. And there's several types of payouts that you need to be familiar with. They're listed here in the presentation based on the largest monthly payment. When the person annuitizes a contract, the payout option that they select will impact how great their payment is. The life-only option guarantees to pay the investor for life, and that's it. Let's say an investor has, over the course of perhaps 30 years, contributed $500,000 to a variable annuity, and they annuitize the contract at age 65, and they get their first check, all happy, and they go down to the bank and deposit the check. They walk out of the bank, walk off the curb, and get hit by a bus. That's it. No more payments to beneficiaries. One check and done. Now, perhaps more appropriate would be a period certain. Life with a period certain. Same scenario. The person has contributed to a variable annuity contract for many years, has $500,000 in there, annuitizes the contract. They trade in their accumulation units for annuity units. They deposit their first check in the bank, get hit by the bus once again, and payments will go to their beneficiaries for the period certain. Perhaps it's 10 years period certain or 20 years period certain. So life with a period certain will have a lower payout than life only. And the longer the period certain, the lower the check. A life with 10-year period certain would have a greater payment than life with 20-year period certain. Now, if the person outlives the period certain, the investor will receive the money until they pass away. Another payout option that could be selected would be joint with last survivor. Traditionally, husband and wife, does not have to be. But here the insurance company or annuity company is trying to calculate the life expectancy of two parties. So with that in mind, that would result in a lower monthly payment. So your biggest payment would be life only, then life with period certain, then joint with life with last survivor. Now, if the husband and wife have an annuity and it's been annuitized joint with last survivor, they're traditionally looking at the life expectancy of the woman because the woman is expected to live longer, and as a result, it would result in a slightly lower payment. Instead of annuitizing the contract, you could have a cash unit refund where you just cash out your contract and invest the money somewhere else, or you could enter into a plan to promise to pay the value of the units over a certain period of time. Now, when we annuitize a contract, we said we surrender our accumulation units for annuity units. And at that time, the insurance company sets an assumed interest rate or an AIR. The AIR is a benchmark that the portfolio must return in order to keep the person's payments consistent for life. That is the assumed interest rate or the AIR. We're going to take a look at the AIR in great detail in just a few minutes here, but first we want to take a look at some of the factors that go into determining the value of the annuity payment. Well, certainly the account value is a significant factor. Do you have $50,000 in your annuity, or do you have $500,000 in your annuity? The payout option you select. Did you select life only, joint with last survivor? What? I think we did a pretty good review of detailing the impact on the payments regarding your payout option. Your age. How old are you when you annuitize the contract? Are you 60? Are you 70? Are you 75? Are you a man or a woman? The payments to men will tend to be higher than the payments to women because men are expected to have a life expectancy that is shorter than those of the female counterpart. So a female's check would be slightly lower because the insurance company has determined that they are most likely going to have to pay them for a longer period of time. And then finally, it's a separate account's performance versus the AIR. These are all factors that go into play when you're looking at the value of an annuity payment. Now, here we have a scenario up in the presentation, and we're taking a look at someone who has annuitized their contract. They've traded in their accumulation units for annuity units, and the insurance company has set an assumed interest rate of 4%. They're saying in order to keep your payments constant at $2,000, which is the value of this person's first check, we have to return 4% per year. So here we have a couple of scenarios where the person has annuitized the contract, they've received the first check, and the insurance company has set that AIR. And here you have month 1 after we annuitize the contract, and the separate account performs well. It performs at a 6% rate on an annualized basis, and perhaps the check goes up to $2,200 the next month. Now, the second month, the separate account performs at a 5% rate. Does the check go up or down? That's right, it goes up, because you're always looking at the payment versus the performance of the account relative to the AIR. You're always looking at the performance versus the AIR, not versus the previous month's performance. It performed at a 6% rate in that first month. Well, that's greater than 4. It performed at a 5% rate the second month. Well, that's greater than 4. So our check goes up once again. Perhaps it went from $2,200 to $2,250. In that third month, the separate account performs at a rate of 3%, and 3% is lower than 4. Therefore, our check falls this month, and it goes to $2,225 perhaps. And in the final month, the separate account performs at an annualized rate of 4%, which equals the AIR. Therefore, our check remains the same as month 3, $2,225. These are all testable concepts. And make sure you understand that when looking at the direction of the check, you're always looking at the performance of the separate account relative to the AIR. All right, let's take a look at some of the implications of withdrawing money from a variable annuity. Money goes into a variable annuity after taxes, and it's allowed to grow tax deferred. When an investor withdraws money from a variable annuity contract, that growth portion is going to be subject to taxation. So let's take a look at a couple of different ways an investor may withdraw money from a variable annuity contract. Well, an investor may just cash in or do a lump sum withdrawal from their variable annuity, and the investor might call up their registered representative and ask them how much they have in their variable annuity contract, and they say, cash me out, send me a check. They receive a nice big check. Part of that check is going to be return of their cost basis or their deposits, and part of that will be distribution of growth and will be subject to taxation. Now, an investor would look at the exclusion ratio here to determine exactly what amount was return of their cost basis and tax-free, and how much was distribution of growth and therefore subject to taxes. If an investor needs to do a random withdrawal from a variable annuity, there are some significant tax implications here. Let's say an investor has placed $10,000 into their variable annuity, and it's grown by $5,000 over the last several years. So $10,000 is their cost basis, and $5,000 is their growth. Let's say once again we have an investor whose car broke down. They need to go out and buy a new car because their car is beyond repair. And the only money they have to meet the down payment on the new car is the money in this variable annuity. And they go into the variable annuity contract and they do a random withdrawal, meaning they take money out on a random basis to meet this expense. Well, the IRS says that random withdrawals done from a variable annuity contract are done on a LIFO basis, last in, first out. The last thing in is the first thing that is being withdrawn, and they say that the last thing into that contract is the growth. So therefore, the investor, when they withdraw money from the variable annuity contract, to buy this car and maybe they need $5,000, that entire $5,000 is coming from the growth. It'll be subject to income taxes, and if the investor is under 59.5, it will be subject to a 10% penalty taxes. So what do you need to know about random withdrawals from a variable annuity? 1, they are done on a LIFO basis. The growth is the last thing in, it is the first thing out. The investor will be subject to income taxes on that amount, and if the investor is under 59.5, the investor will pay a 10% penalty tax. What if the investor needed $6,000 to buy that car? Well, once again, they had deposited $10,000 after taxes. It grew by $5,000. When they are withdrawing $6,000, well, $5,000 once again will be coming from the growth. They'll be subject to ordinary income taxes. If they're under 59.5, a 10% penalty tax. And they will receive that remaining $1,000 tax-free from their cost basis because they've already paid taxes on those deposits. Now, when an investor annuitizes a contract, part of that monthly payment is going to be return of their cost basis, the money they put in there, and part of it is going to be the distribution of growth and subject to taxation. And once again here, the investor is going to look for the exclusion ratio at tax time to determine what their tax liability is on each payment. So again, the exclusion ratio tells the individual how much of the payment is return of cost base or their deposits, and how much is distribution of growth and subject to ordinary income taxes. Variable annuities are non-qualified plans, meaning they do not qualify for pre-tax contributions. Variable annuity contracts are not subject to required minimum distributions or RMDs like IRAs and other accounts. Now, let's take a look at a variable annuity versus a mutual fund, and this tends to help clarify a lot of points for individuals and really helps them on the exam. So we have features, we have the variable annuity, and we have mutual funds. Now, the investment objective for a variable annuity is income only. It's income now or it's income later. So the investor has to have an income objective in order to be suitable for a variable annuity. Mutual funds, well, you can buy a mutual fund for an investor who has a growth investment objective or an income investment objective. A variable annuity has no maximum allowable sales charge. It is whatever is reasonable. The maximum allowable sales charge on an open-end mutual fund is 8.5% of the public offering price, or 8.5% of the total amount invested. Both variable annuities and mutual funds have investment advisors. Both have voting rights. Now we start getting into some of the significant differences between variable annuities and mutual funds. The growth on a variable annuity is tax deferred, meaning the investor does not pay taxes on that money until they withdraw it. A mutual fund's growth is currently taxed, regardless of whether the investor takes distributions from their mutual fund account or leaves them in the mutual fund to purchase additional shares by reinvesting them. That investor will pay taxes on those monies. A variable annuity could promise the investor a lifetime income stream where the mutual fund cannot. Costs associated with a variable annuity are incredibly high. There are a lot of expenses, there are a lot of fees. The costs with mutual funds are significantly lower. Liquidity. The ability to access your money on a variable annuity is very low. You have surrender periods, which are often years, and should you need to take a random withdrawal, you're going to have tax implications. You'll be paying at least ordinary income taxes, and if you're under 59.5, you'll be paying penalty taxes. Liquidity is very high with an open-end mutual fund. You want to liquidate it, Just redeem your shares at the net asset value and the check will be on the way. No surrender periods at all. Suitability requirements. The suitability requirement is significantly higher for a variable annuity than it is for a mutual fund. What am I talking about? In order for a variable annuity to be suitable for an investor, the registered representative has to be able to check a lot more boxes than they would for a mutual fund. The investor must have a long-term objective, does not need access to the money, is comfortable with the fees and expenses, and is okay with the surrender charges and potential tax implications. That's a lot of boxes to check. The mutual fund investor only needs to have a mutual fund that meets their investment objective and be okay with the expenses and fees. And again, the expenses and fees in a mutual fund are significantly lower than those for the variable annuity. So when you're looking at the suitability for a variable annuity, there is a significant amount of suitability inquiry that needs to take place. The principal of the broker-dealer has 7 days to approve or deny an annuity application based on suitability. And not only does the annuity wrapper have to be suitable for the investor, so does the allocation of the money into the separate account. So the annuity contract itself must be suitable, and the allocation of the money into the various separate accounts offered by the annuity company also have to be suitable. This has been an excellent review of variable annuities. You're all likely to see multiple questions on these concepts on your exam. Make sure you understand the suitability requirements and the operational aspects of these contracts. Please review this section a little bit more closely. Take some tests in our test bank and review our textbook for some more details. And we'll see you in our next section.